Pleasant afternoon to everyone joining us today, shareholders, clients, the wider investment community. A very warm welcome to the Barita Beat, the pulse of our performance, which serves as a principal source of insights on our quarterly earnings and all the pertinent information related to our financial performance and investment thesis. Today, we'll be reviewing our recently published fourth quarter earnings ending September 30th, 2023. I'm Kerry Bayliss, VP for Strategic Business Development and Investor Relations, and I'll be the moderator for today's presentation. It's my pleasure to introduce the members of our executive team, who will be our keynote speakers for today's earnings call. Dane Broadbaugh, our interim CEO, Ramon Small-Ferguson, Deputy CEO, and our Managing Director for Barita Unit Trust Management Company Limited, and Stephen Philibert, our Chief Financial Officer. The format for our presentation today will start with the 12 months financial performance, followed by a business review highlighting our 5-year post-acquisition progress, and we will also take the opportunity to discuss the business operations and strategy. We very much want to engage with you. We want to hear from you. So at the end of this, we will have a Q&A session. So please feel free as we go along to enter your questions into the Q&A section, and we will do our best to answer as many questions as we can before we conclude today. So without further ado, I will hand over to Stephen to take us through the Q4 financials.
Thank you very much, Kerry, and good afternoon, ladies and gentlemen. Okay, we'll begin with the operating income. Net operating revenue increased by 143 million, or 1.6% to 580 that's 9,095 million versus 8,952 million. And that's comprised of different components moving in different directions. So net interest income showed a decrease by 1.1 billion, or 65%, to 581.2 million from 1.67 billion in the prior year. Fees and commission income increased to 3.4 billion from 3.0 billion in the prior year. We also had an increase in gain on investments, which is up approximately $1 billion to 4.36 from 3.36 in the prior year, whereas FX trading and translation gains is down about 24% to 604 million relative to 792 in the prior year. On the expense side, we saw expenses increase to 4.6 billion from 3.8 in the prior year. It's primarily driven by an increase in the administration costs up to 2.88 billion from 2.09 in the prior year. Staff costs are roughly flat to 1.73 billion from 1.71 in the prior year. And the ECL, or impairment expense, is minimal. It's actually a $4 million write-back just relative to shifts in the loan portfolio itself. So that takes our efficiency ratio for the year to 51%. Looking at the financial position, we see to the audited prior year that total assets moved to 128.6 billion from 109.7. That's a 17% increase. We see that our securities portfolio, which is the combination of the pledged assets line and the marketable securities line, moved to 106 billion from just under 86 in the prior year. So that's a $23 billion increase, and the lion's share of the increase in overall total assets. On funding side, so the total liabilities are up to 93 billion from 77.5, or about a 20% increase year over year. And that's driven predominantly by an increase in the repurchase agreement line, which is up to 76.5 billion from just under 60 as at the end of the prior year. That's a 28% increase. We also have an increase in the other debt facilities line pursuant to Barita's bond issue, which took the line to 8.3 billion from just under 700 million in the prior year. And that's partly offset by a reduction in the secured investment notes line to 5.9 billion from 11.2, or down about 47%. Shareholders' equity has increased to 35.5 from 32.2, about a 10% increase, and that's driven by retained earnings. So on a per share basis, earnings per share is $2.81 for the year relative to $3.18 in the prior year. The company's capitalization remains very strong. The capital adequacy ratio sits at 28.6% relative to an industry average of 21.2%. And of course, the FSC's minimum requirement is 10%. And we have here just a recap of some of the financial highlights, which I've spoken to before. Net operating revenue at $9.1 billion, again, profit at $3.4 billion, shareholders' equity at 35.5. With that, I'll hand over to Ramon Small-Ferguson, who will give us some of the context for this performance.
Thank you very much, Stephen. Afternoon, everyone. So I want to kind of start with attaching a longer-term time frame to Barita's performance relative to the 1 quarter view that Stephen just touched on. And the period I want to cover is our post-acquisition period, the period since we were majority acquired by Cornerstone Financial Holdings Limited in August of 2018 to now. Over that period, Barita has experienced a transformation, which I think is evidenced most starkly by the significant shift in several of our metrics, right? And some of them are on screen. Net profits are up over 820% in the 2023 year relative to the 2018 year when the company was acquired. That is against the backdrop of an almost 600% rise in net operating revenue, which has also been characterized by significant diversification due to the introduction of new business lines and new asset types into the company's portfolio. The platform supporting this rise in revenue and profits has been our very steeled and disciplined focus on growing the shareholders' equity, the capital base of the entity. Stephen spoke earlier to our capital adequacy, which is well above industry levels and regulatory minimums. Our shareholders' equity has grown by over 1,000% during the post-acquisition period, and that has fueled growth in total assets by over 580%. Right? An area of focus for us, as I mentioned, has been revenue diversification. And against that backdrop, you would note that total revenue has grown by almost 600%, but non-interest income is actually up almost 1.5 times that percentage total by 865%. Total assets under management are up, or is up rather, over 280%. And finally, all of that has translated into our share price, which is up over 300% during the post-acquisition period. Now, there have been several activities that have really underpinned our financial performance. I mean, I mentioned the launch of new business lines as one. We would have launched our investment banking business in December of 2018, and that business has become a main staple to our performance in the present day. During the period since that business was launched, we would have completed transactions totaling north of 120 billion Jamaican dollars, translated across several asset classes: debt, equity, both public and private, private credit. We have also funded several projects related to infrastructure and real estate during that period. It has really been a focal point for our business and has created several opportunities, not only for the direct clients benefiting from the services emanating from our investment banking business, but our investors as well. We've done several landmark transactions, the largest additional public offering on the JSE, the largest junior market offering on the Jamaica Stock Exchange's junior market. We have done the largest cross-listing on the JSE as well. And year to date, we've done the only initial public offering that has come to market in 2023. So we have really been focusing on making inroads in that business. Other areas of our business that have shown standout performance include our brokerage business. We would have moved that business from being sixth in terms of market share up to second in 3 consecutive years. And year to date, we are first by value traded. On the Cambio side, we have seen a similar leap from sixth in the pre-acquisition period to second largest Cambio in the present day. We have also expanded our direct reach through our social efforts via our foundation, diversifying the focus of that foundation that previously had a predominant focus on education. So education remains a key pillar for us, but we have expanded our focus to include financial literacy and health as well, and several other areas. So as I mentioned, the key theme for the business in this post-acquisition period has been transformation, and that transformation has translated to significant growth as evidenced by what's on screen, right? So now to get into the usual context, and I'm really singing a very similar song to the last couple of meetings, but I think with a clearer tune. On the local front, the local economy remains robust, all things considered, and we are seeing favorable near-term growth expectations, right? And the factors really underpinning that favorable near-term growth expectation across the board really relates to the rapid decline in public debt and the entrenched macroeconomic stability emanating from the combination of fiscal and monetary policy, right? Now, we have seen evidence that these policies are taking hold, not only in the metrics that are coming out in terms of the economic variables, but since our last meeting, Jamaica has actually benefited from a couple of credit upgrades from both S&P and Moody's, who have recognized the almost entrenched and structural decline in Jamaica's sovereign debt. Right? Locally, the defense against high inflation is really taking hold. Inflation cooled to 5.9% in September of 2023, and that's down materially from the peak of 11.8% in April 2022, right? Notably, it hit a cycle low of 5.8% in April of 2023, and the BOJ's MPC continues to hold the policy rate at 7% amidst the heightened surveillance around the various risks emanating from the local economy and the global economy. I mean, importantly, we would know that there has been tremendous monetary policy tightening characterized by higher rates and lower market liquidity in the face of high inflation. And we have actually seen evidence that some of that is actually working and making its way through lower inflation, right? On the global front, the IMF has revised global growth higher, right? And they're citing more resilience in developed economies, not least of which are the United States, than would have been previously anticipated. Now, notwithstanding, the forecast is highlighting below average economic growth, and that's tempered by uncertainty with respect to the macroeconomic backdrop. There are several factors at play. There is heightened geopolitical risk relative to what would be normal. There are several sections of the global economy still fighting high inflation. The supply chain challenges are still being mentioned as a buzzword in different sections of the world. Now, inflation is easing broadly though, but in most economies, it remains above target levels, right? There has been weaker than expected demand in China, which is one of the largest economies globally, and a gas build up in Europe. But there has generally been, despite spate of supply chain issues, a theme of normalization of supply chains, underpinned by the fast pace of reduction in inflation in most countries. So still above target in many instances, but well below peak levels. Underlying core inflation is set to decline now more slowly on the back of that rapid decline that we would have seen in recent months. So let me talk a bit about the vectors of our performance. I mean, what has really been the ingredients underlining our results, right? The challenging policy environment that I mentioned, the tight monetary policy environment has seen interest rates go higher. Stephen spoke to the impact that would have had on several sections of our business. Net interest income would have declined materially year over year, as the increase in interest rates coming from a policy perspective has translated its way into the money and capital markets. And that would have in turn increased our funding costs and driven down net interest income, right? Or capital allocation to alternative investments has actually been a standout with respect to our performance year to date. In the context of fairly loose monetary policy, we recognized that we needed to diversify our portfolio holdings and position ourselves to have resilience in an environment where that monetary policy position reversed, and consequently we would have allocated capital to various segments of the alternative investment spectrum: private credit, private equity, and real estate. And we have been benefiting from the lower correlations that those assets usually have with traditional variables such as interest rates and the fortunes of the equity market, right? Traditional asset class returns have either been negative or marginal year to date. And if we look at the Jamaica Stock Exchange's index, for example, we would see that several segments of that index, to include the broad main index, are down. If we look at global bonds, both on the risk-free end in terms of US Treasuries, yields are generally higher than the start of the year. Or in emerging markets, if we look at government of Jamaica debt as a proxy, despite an improvement in credit quality, generally speaking, prices across the board on these type of investments are down. Now, while we expect to realize continued returns in segments of the alternative investment portfolio in the medium term, we anticipate that the pace of growth that probably would have been seen historically in these type of asset classes may slow or may ease as we move through the cycle. Our real estate portfolio, as we would have mentioned in our chairman's report, we anticipate that we will move away from revaluation type gains primarily and move towards cash-based revenue from development type activities over the next turn of the cycle with respect to this particular strategy. And we think as monetary policy evolves, we're really constructive on the prospects for net interest income and maybe a somewhat better trading environment as we see rates either remain more stable or potentially decline as we again move further through the cycle. So what are the key takeaways? On the investment banking front, I mentioned where the focal point of that particular business line is. They focus on structuring deals for corporate clients, both locally and in the region. And following a challenging environment in 2023 that was characterized by lower than typical activity on the equity front in terms of people raising equity. I mentioned that there's been only one IPO year to date. And of course, high interest rates, leaving some clients a bit shy to seek to raise debt capital. We are more optimistic about the environment for capital markets type transactions as the monetary policy outlook becomes a bit more stable and certain, right? On the money market side, I spoke before rather, about the impact that monetary policy has had on our funding cost and therefore the net revenues that we earn against our liabilities. There, both the BOJ and the Fed have paused with respect to their rate hike cycles, and the outlook there is certainly for a less sharp and less significant move in rates, even to the extent that they were to go higher than what we have seen in the past. And in fact, there is an outlook that is tied to a potential reversal of the trajectory in the next year to 18 months. On the securities brokerage side, trading volume in the market has been low, given the impact of higher rates and what that has done to investor confidence, right? And I mean, we believe that even if macroeconomic factors continue to move directionally in a way that would support the return of this type of activity, there may be a lag. So while we're constructive, we are a bit less optimistic about an immediate return of robust trading. And finally, on the fund management side, certainly we have increased our focus on alternative investment exposures here, but suffice to say, we are expanding and diversifying to include a focus on growing traditional funds under management on the asset management side. I mean, Stephen, I think, would have spoken about the growth in assets under management year over year rather, a modest 5%, even against the backdrop of a fall off in values in the portfolios that we manage, resulting from decline in equity market, decline in fixed income market, etc. We've actually managed to show some growth there. Right. On the alternative investment front, the real estate platform has been established. It's been a key part of our business with respect to the diversification effects. I mentioned that we may see a cooling in the pace of growth and a shift in the focus in terms of income there. And on the Cambio end, as I mentioned, we are the second largest Cambio in Jamaica, and we will continue to seek to grow our market share there and serve our clients as their broker in the FX market. And with that, I will hand over to our interim CEO, Dane Bradbaugh, to take you through the details of the operation of the business. Thank you.
All right. Thank you, Ramon. All right. So Ramon would have outlined the various elements of the macroeconomic environment, right? And those are clear and present. And of course, we position ourselves tactically based on our outlook. But more strategically, we remain focused on building a resilient business to serve us well into the future, building on the foundation of the robust capital base that we have, building on the investments that we've made post-acquisition on our governance and control environment. So we continue to take steps to future-proof our business through investments in technology, diversifying our revenue streams, and optimizing various elements of our business to enable our evolution. So, we've really reaped the benefits, as Ramon would have mentioned, of the deliberate strategic allocation to alternative investments, and in particular real estate, right? And that has largely offset the impacts of the restrictive monetary policy backdrop, particularly its impact on net interest income. And as you'll see, over time, we've reduced our reliance on net interest income to the extent that most recently, our net interest income accounts for just 6.4% of our total revenue. On the area of risk governance and internal control, we've really made significant investments in that risk compliance and internal control architecture, and which really allows us to proactively manage risks, remain compliant, and importantly, safeguard our clients' funds in line with industry best practices. Now, our efforts at improving our governance would have caused us to be assigned an A rating in the JC Corporate Governance Index for the 2022 period. that is against an industry average of CC. Now, we maintain the same rating this year, but we're still making improvements in key areas. We have fortified our operational processes and IT controls to ensure client safety and the institution's resilience among emerging cyber threats. We've further reinforced our first line of defense through establishing our first line governance structure. And of course, we ensure that we recruited top talent with global experience and best practices in our second and third lines of defense. Now, it's really been a substantial and deliberate investment to ensure that we have a strong foundation for growth. And we've really come a long way since acquisition, and we believe that this will make us even more formidable in the future. On the product development side, we have recently launched our portfolio management services to offer bespoke and highly customized and personal investment solutions to our customers. On our operating platform, we have made significant headway on our core system replacement project, which is expected to be underway in this financial year. And we've made further enhancements to our Barita online interface, facilitating more accessible communication and client servicing, allowing clients to initiate orders, submit KYC information, and submit and track complaints and queries. We have also rolled out our Barita GPS roadmap. It's an online interactive platform that customizes portfolios based on our clients' goals, risk appetite, experience, and approach to investing. Now, as we've made those investments, we've remained focused on ensuring that we're good stewards of our resources through our focus on expense management and optimizing the scope and scale of the resources allocated to our various business lines. And meanwhile, as we move through our planning for our reorganization, we look forward to further unlocking value as we take the opportunity to make our structure more wholly customer-centric and use the opportunities to leverage and optimize capabilities across the group. Now, our ability to remain resolute in the execution of our strategy, even through what has been a challenging environment, was largely a function of the strength of our capital base. This allowed us to continuously demonstrate strength in the face of volatility, while we kept our heads down to execute the various necessary initiatives to build our resilience, future-proof our business, and build a strong base for growth. Again, as I have mentioned previously, our strength of capital is important because it gives us the ability for growth, both organically and inorganically. It allows us, as demonstrated this year, to comfortably withstand shocks. And given the nature of the assets resident in our alternative investment strategy, it provides a stable funding base to support that strategy. So, for example, equity currently funds around 28% of our assets, relative to an industry average of around 16 to 17%, which really makes Barita uniquely suited to pursue this strategy. And again, our strategy to build our capital base was a direct complement to that alternative investment strategy. So, for the upcoming year and years to come, we're going to continue to future-proof our business through investments in technology. Our core system upgrade is going to remain our priority for implementation this year. Meanwhile, we continue to enhance the capabilities of Barita Online and continue to encourage our clients to utilize that channel to review investment balances and performance, initiate orders, and where necessary, update their information or leave any queries or complaints. We're going to ensure that having built our governance and control framework, that we maintain this through continued disciplined execution of our prescribed controls, while we continue to make improvements to ensure that we're on top of emerging vulnerabilities and plug any residual ones. We're going to, of course, diligently deploy our capital while maintaining adequate liquidity as we continue to execute on our alternative investment strategy. We're going to continue to work to optimize our business among various dimensions. We want to optimize how we're structured for customer centricity, particularly as the group executes its reorganization. We want to optimize the deployment of our human and technology resources to ensure adequate resources for higher value activities, and optimize our financial resources to ensure the best use of the risk capacity embedded in our capital and our liquidity. And finally, building on the products that we developed last year, including the portfolio management services and the Barita GPS, to grow core areas of our business while executing on other product development initiatives to ensure a more rounded suite of products for our clients' investment needs and broaden our distribution capacity. So, on behalf of the team, I want to thank you again for tuning into our Q4 investor briefing as we give you a first-hand view of what's going on and our future plans for your business. So I'll hand over to our host, Kerry Bayliss, to lead us into the Q&A session.
Thanks, Dane. And thanks again to our executive team for that very comprehensive review. And of course, for touching on some very noteworthy achievements. So we'll now start what is my favorite part of the earnings call, which is our time to engage with you, the audience. So we'll jump straight into the Q&A section. Just a reminder, if you do have questions and you haven't already put them in the chat, please do look out for the Q&A tab and drop them in there as we go along. And as mentioned, we'll try our best to answer all of the questions or as many as we can. So a few questions have come in throughout the presentation. A number of persons asking some similar questions. So let's start with the most popular one. Are there any updates on the plans for the purchase of the real estate in St. Mary, Portland?
I'll probably take this one, Kerry. So, I mentioned a couple of times our alternative investment focused strategy, and a subset of that is what we're doing on the real estate front. We have, in fact, made investments in real estate on that end of the island, the eastern end of the island, specifically in St. Mary. Now, with respect to updates on the plans, where we are in that investment cycle is as follows. Well, let me describe the cycle to you. All right. So the first end of things is the investment phase, where you acquire properties and curate them in a portfolio that would then serve as the basis for the strategy. Now, where we are in the strategy, we've moved away from the acquisition phase, and I think we have acquired the properties that we intend to form the portfolio. And we're at the value add stage, where we will be developing or redeveloping the properties in the portfolio with the objective of unlocking the value that we believe is embedded in them. Right? Now, with respect to the specific properties that the inquiry was about, we have made several steps with respect to deciding exactly what the highest and best use of those properties are. That has involved, investigating the efficacy of various options at our disposal, design work, infrastructure improvements, and importantly, ensuring that we have the requisite resources, be it partners, financiers, etc., to really deliver on the best value type product from those plots of real estate. So very advanced. We anticipate that the build-out phase or this value-add phase will be in stages, and therefore we won't be developing all of the pieces of real estate all at once or redeveloping all of the pieces of real estate all at once. So we're intending to sequence it around several considerations, not least of which are market conditions. Right, so we're not going to be building for building's sake. We're going to be ensuring that we are trying to sync up the delivery of the product that will come from these developments and redevelopments with good market timing to receive those products. So well on the way with respect to planning and more to come with respect to the actual build out.
Thank you, Ramon. So our next question is in relation to dividends. So this person is asking why no dividend was declared this year, and are there any plans for a dividend to be paid?
Thanks for that question. So, we continue to take a risk-based approach to dividend payments, based on the current and expected market environment. Now, management and the board are continuously assessing the various considerations, which will inform the ultimate decision both on the timing and the quantum of dividends. And we'll be sure to keep our shareholders informed of that outcome.
Thank you, Dean. All right, the next question I think is one for you, Stephen. Mr. Samuels is asking, stating BIL's efficiency ratio has been trending up year over year to a high of 50.7% as at financial year end of 2023. While still acceptable, can you please provide some perspective as to whether there's a credible case for delivering a lower efficiency ratio? Can you also explain some of the things that you're doing to maintain efficiency in the low 50s or high 40s region? Or are there structural factors supporting this higher ratio?
Yes, thank you, Kerry, and thank you, Mr. Samuels, for that question. So we've been pretty consistent setting out our investment plans. So this is structural investments in the business. So the efficiency ratio, the level that it's at, is driven by those investments that we're making in building out the team, building out the systems, and this is going to be taking place for a period of time. Beyond that period of time, we expect the efficiency ratio to improve once we're no longer doing that structural work, that work of improving the basis of the business for the future growth that we intend for it to have. So what we are doing to manage, aside from that, is where expense lines are not additive to our structure, not additive to our ability to support that growth. We're pretty ruthless in terms of driving those costs out of the business to the extent that we can.
Thank you, Stephen. All right, our next question is, are there immediate plans to list MJR Holdings? And also, are there any plans for Barita to do an equity or debt raise in the near future?
Thanks for that question, Kerry. So, I mean, naturally, given the nature of the question, there is a limited amount that I can say, right? Because it would see me making some very bold future statements. But suffice to say, Dean, Stephen, and myself spoke a good bit about the nature of how our business is funded and the work that we would have done in the earlier years of the post-acquisition period to build our funding capacity via several equity raises and other fundraising initiatives. Right. So, in that context, we do think that we have very good capacity to grow as we are, and I'll leave it at that. Now, with respect to MJR, presently we are very focused on delivering value through, as I mentioned before, the activities that characterize the value add phase, right? Not so much focused on corporate structure or listing, etc. At this present moment, but with respect to that and many other things, there are great possibilities. So the focus there, though, in the near term is really delivering value through the value add phase of the investment strategy. Right, that's the near term focus.
Thanks, Ramon. I actually have another question for you. All right, so a member of the audience is asking, what is the reason for the performance of the Capital Growth Fund and what is the outlook for same?
Thanks for that. And I actually got this question last time. Unfortunately, markets have not become kinder in that period. So I have to come back with words of reassurance. So, I mean, I spoke to the broad macroeconomic backdrop. Equity markets in several areas of the world, to include Jamaica, where the Capital Growth Fund is primarily invested, have been having a hard time coping with higher interest rates. Higher interest rates have not only presented a very attractive alternative for investors who have seen lower rates for some time, but the attendant effects or the complementary factors such as low liquidity in the money market have also and the slowdown in the capital market, new fundraising, new IPOs, etc., have also, I think, dampened the investor confidence and the upbeat mood that helps to complement improvement in fundamentals and helps to drive generally market performance. So we've continued to see somewhat of a lull in the market, and therefore the securities that the fund is invested in have been having a hard time over the last couple of quarters. That being said, I mean, an equity-focused strategy is long-term. This fund is actually our oldest fund. It's been around for over 30 years, right? And it would have come to market at $1 and is now trading several fold higher than that dollar, right? I think it's now trading in the 80s or so. Should mean it would have moved from $1 to 80, right? Now, in that context, there have been several downturns in the equity market since the early 90s when this fund came to the fore, right? Which really evidences that despite the up and down cycles, the equity strategy over the long term has really borne significant fruit, right? So that's the advice that I would give to anybody who is either invested or seeking to invest in the fund. What is important is that you have a portfolio that isn't concentrated, right? So what I would hope is that your portfolio isn't entirely or substantially comprised of equity type securities, right? I mean, that would be a painful experience during this period. Instead, if you have a more balanced portfolio, what you'd likely be seeing is a downtrend on the equity side for this period, maybe an uplift in the return that you've been seeing on the fixed income. And if you're allocated to maybe some real estate or real estate fund, for example, has been doing well, you would see an uptick there, right? So historical performance, I've given the context in terms of outlook. I spoke a bit earlier about the fact that we're anticipating a bit more policy stability. Even if rates go higher, we don't anticipate that they will go higher at the same pace, and certainly not at the same or to the same degree that they have before. And that kind of outlook, certainly relative to what we have experienced in the recent past, is a better context in which equities could potentially perform to a better degree. So our outlook, we are cautiously optimistic. Read the prospects for the local equity market. We're certainly seeing some bright spots with respect to company performance, and we anticipate that as we move through the economic cycle, that will translate to performance with respect to share price, and therefore improve the fortunes of our equity fund.
All right, so our next question comes from Mr. Edwards. He's asking, how does Barita stack up against the other financial investment firms? Ramon, you want to take that one?
Sure, since I'm already speaking. So it's a very far-reaching question, right? But I can talk about the things that we like to emphasize in terms of some of our key differences. One is the focus that we have placed on ensuring that our entity is funded with a significant or sufficient, more than sufficient endowment of equity capital, right? Dean spoke about the fact that almost a third or so of our business is funded by equity capital, or almost 30%, relative to the rest of the market, where their businesses are generally funded about 15% or so with equity capital. What that means is twofold, right? There is both a risk management effect and also an opportunity effect. On the risk management front, what it means is that our business, all else being equal, and just to qualify it, would be more resilient with respect to its ability to absorb shocks to the business because of that higher buffer, that higher capital base relative to most of our peers, right? And we see that as a standout. It means that we can survive tough times. It means that, when interest rates rise to a significant degree and the price of the bonds that we all hold fall, and that translates to a reduction in capital, we still have a very healthy endowment of capital even after you make those adjustments. And we think that that's a standout feature, especially given our size. On the opportunity front, it also makes us more capable. So because of that healthy endowment of capital, we are able to potentially take advantage of opportunities under circumstances where some of our competitors may be constrained. So they may not be able to buy as much of this particular security or fund this particular deal, given their relative capital levels, right? And that has been something that we have certainly used to our advantage over the course of the last couple of years, particularly in supporting our investment banking business and our general investment strategies, right? So that's one area for sure where we believe that we stand out, right? Dean spoke a bit about our investment in risk management and compliance. And I mean, I suspect that that's an area that business is focused on in general. But what we have benefited from, particularly given our circumstances, the fact that we would have been taken over in recent years, is that we have been fortunate enough to be able to take a very deep and objective look at our control environment, our risk management frameworks, our governance frameworks, and apply best-in-class standards to it. So we've been able to, as a team, many of us just coming into the business, take that dispassionate look. And we have employed the help of several very well noted and experienced entities to build out our risk and governance and compliance frameworks. And we believe that that has redounded to our benefit, and it shows up in these tough times where we have been very resilient in the face of a pandemic, very resilient in the face of high interest rates, and that coming to us very quickly, and just general market volatility. We think that is a strength of ours as well. And finally, I mean, this is much more intangible, right? But I believe that, and it really emanates from the general modus operandi of our group to challenge the status quo. I mean, if you look at our mission and vision at Barita, to stay ahead and grow wealth, and to really revolutionize the relationship that our clients have with money, it really is underpinned by innovation and a spirit of thinking outside of the box, of really growing the pie and seeking to move the needle forward with respect to how we see the role of the capital markets in the development of Jamaica on one hand, but also with respect to the impact that it has ultimately on the lives of individuals. And we try to apply that solution-oriented thinking and that uninhibited thinking, albeit while coloring within the lines, right? I spoke about the risk management before, to the various areas where our business touches the common man, the business community, the economy, all our stakeholders, right? And I think that focus on staying ahead and growing wealth, and that focus on continuously challenging the status quo does set us apart as well. So I've given you a few things. I can go on, but we have a limited time, all right?
All right, so the next question is from one of our valued clients. They're asking, as a Barita client, should I be expecting information and advice reinvestment opportunities, such as investing in gold, minerals, and technology in the international market?
All right, thanks for that question. So, at Barita, we're always looking for attractive and innovative ways to provide products and services that meet the needs of our client base. So, while we don't necessarily cover those markets directly on an ongoing basis, our team is capable of providing the necessary analysis and insight that will support any product offering that we introduce to our clients with those underlying exposures.
Thank you, Dave. I have one more question for you as well while your mic is warm. All right. How does Barita Investments plan to navigate challenges in the dynamic financial landscape?
All right, thanks for that question. So, moving forward, Barita, obviously, as I mentioned, we remain committed to innovation. We remain committed to prudent risk management and sustainable growth, and that's really our North Star as we look to navigate the various challenges. As I mentioned, the outlook that we have, based on how the macroeconomic backdrop is likely to evolve, will inform some of how we tactically position ourselves. But we're really still focused on our strategic plans and really building a resilient business for the future. So, as I mentioned, our strategic plans involve leveraging innovative solutions to address evolving market needs, and while ensuring responsible and ethical business practices. And, we maintain a balanced approach that fosters long-term growth and value for our stakeholders. So again, the current market environment may be challenging, and again, it's a tightening cycle, right? So it's expected to be painful. I think, as Raman would have mentioned, we would have positioned ourselves well, based on the strong capital base that we have to withstand those shocks, while really allowing us to keep our head down and execute the key elements of our strategy, largely around investments in technology, or alternative investment strategy, ensuring that we maintain discipline in our control environment and risk management, and really optimizing the business to ensure the best use of our people, technology, and financial resources.
Thank you, Dane. All right, we've had some great questions coming in. So just a reminder, if you have any that you want to include, please drop them in the Q&A section. We do have time for just a couple more. Raman, I think this one is a question for you. It says, the exceptional increase in investment gains is highlighted in a press release. Can you provide insights into the factors driving this growth, particularly the mention of alternative investment exposure?
Sure, thanks. So that particular section of our profit and loss statement really combines a couple of exposures substantively, and I think we get into some of the details typically in our chairman's report, and we would have in the last. It really is divided across three main areas. Well, two broadly and three specifically: alternative investments and traditional investments. So on the traditional investment side, it captures the performance of our equity type exposures, as well as our fixed income exposures that are fair valued through the profit and loss statement, right? So equity portfolio that we have on our management or on our balance sheet, and elements of the fixed income portfolio. On the traditional investment side, the underlying drivers of that have been private credit exposures that have equity-like features, right? So, private credit exposures that may give you rights to equities or equity exposure in different companies. And also our exposure to real estate as well is captured in that line. So all three of those different exposures combined to have fueled rather the improvement in that line, I think from about 3 billion last year to 3.4 billion this year. So I hope that answers the question.
Thank you, Raman. All right, our next question is, what advice would you suggest to someone who doesn't understand much about shares? Daniel, take that one.
So very good question, right? And I suspect that question may be reflective of questions that several others may have. I think that the first thing is if you're interested in investments, which you should be, then the first thing I would say is definitely come in and talk to us. Our advisors are well equipped to walk you through the various elements of what the stock market is about. Now, what we've also done, which I mentioned before, is we've launched our Barita GPS. And what that really does is look to ask you fairly straightforward questions about, your particular circumstance, what your approach is to investing, what your experience is in investing. And, based on that, would design a customized portfolio for you. Now, part of that customized portfolio will very likely involve investments in our unit trust funds. And what that really does is pretty much put the burden of understanding the various markets on us, right? I mean, we have professionals that will manage that pool of assets, which will include your funds for you, and navigate those equity markets on your behalf. Now, over time, as you're investing those funds, and you're able to see the results in your portfolio, that contact with our advisors over time will sort of help you to, definitely over time become a lot more comfortable with the equity markets, and eventually start doing those investments on your own. But I think at the stage that you are at, it would be most helpful for you to go through our Barita GPS process and be invested in our funds so that we can manage those funds on your behalf and navigate those equity markets for you.
Thank you, Dane. I think I have one more question for you as well. So this question is stating, looking ahead, can you clarify what focus we have on any innovative solutions for sustainable growth? And can you elaborate on the company's strategic plans and initiatives in this area?
Okay, so, as we have mentioned, as we have telegraphed in terms of, how we're looking to position ourselves based on our outlook, adapting to the dynamic financial landscape is a key priority for us. Again, we remain focused on proactive risk management and really, fit for purpose risk management, ensuring that we build and utilize the risk capacity that we have to really optimize our investments. And of course, there's the continuous monitoring of market trends and, developing strategies that are really flexible, that are able to adapt, at least tactically, to various environments. So, by staying agile and responsive to challenges, we'll continue to navigate them and position ourselves for sustained success in the future. Again, the overall theme is that, we, based on our outlook, we position ourselves tactically, but our primary focus is on the execution of our strategic plans to ensure that we build a resilient business for the future.
Thanks, Dane. So that was our final question for the afternoon. Before we give our closing remarks, I just wanted to acknowledge Jerome, who asked if his question was answered. It was answered, and we are aware that there was a brief lag during the Q&A. So I just wanted to let all of our audience know that if you did miss any of the Q&A or you joined us late, we will be posting this session on www.barita.com/beat. So you will be able to catch everything after we conclude. I think we've just about reached the 1 hour mark. So I just want to thank our audience first and foremost for joining us this afternoon and for your questions. I would like again to thank the executive team for taking us through the financial performance and our key operation and strategy. It's been a pleasure, as always, getting the chance to speak with you and to engage with you and share what is happening with us at Barita. So once again, please feel free to catch anything that you would have missed at baritabeat.com. And we look forward to seeing you on the next round.